Gold is sitting at over $5,100 an ounce. Right now, today, silver is hovering around $84 to $85, having already touched $121 earlier this year. And oil? Oil is caught in a tug-of-war between a Middle East war and a global oversupply crisis, sitting roughly around $75 a barrel. But here's what every single financial headline has in common today, March 5th, 2026. One word, 6 syllables. The most searched economic term on Wall Street right now. Stagflation. Prices going up, growth going down, jobs under pressure, and nobody in Washington seems to have a plan. Stay with me, because by the end of this video, you are going to understand exactly what is happening in gold, silver, and oil, what the world's biggest banks are saying, and what it means for your money. Let's break it all down, right now. Verdidios disclaimer. Before we dive in, and we are going all in today, quick disclaimer. Everything in this video is for educational purposes only. None of this is financial advice. I'm not your financial advisor. Always do your own research and speak with a licensed professional before making any investment decisions. Prices are volatile. They change every second. Got it? Good. Let's go. Let me start with the big picture, because nothing in the commodity markets makes sense unless you understand the economic backdrop we're operating in right now. The word everyone is whispering on Wall Street and screaming on Main Street is stagflation. Now, if you're not familiar with that term, let me break it down for you in plain English. Stagflation is what happens when you get the worst of both worlds at the same time. Inflation going up, economic growth slowing down, job market getting squeezed, all at once. It's the economic nightmare scenario that most Americans thought we left behind in the 1970s. But in 2026, it's back, baby. RBC Economics, one of North America's most respected research institutions, is outright calling it. And I quote, "The U.S. economy is increasingly on track for a stagflation-light scenario. Growth is too slow, inflation is running too hot, and the gap between the wealthy and everyone else is widening by the day." RBC's own global capital markets team said it even more bluntly. Unfortunately, the concept of stagflation light will persist and may actually worsen in 2026. And it's not just RBC. Goldman Sachs has flagged elevated recession risk. Bloomberg ran a dedicated newsletter piece titled, and I'm not kidding, "Tariff-induced stagflation fears hit Wall Street." CNBC called it a growth scare. President Trump's sweeping tariff agenda has pushed America's average tariff rate to roughly 17%, the highest it's been in nearly a century, and the ripple effects are everywhere. Companies can't plan long-term. Manufacturers are freezing investment. Consumers are watching prices tick up at the grocery store, at the gas station, at the hardware store, and economists at Stanford's Sci-Par Institute have been clear. When you layer tariff-driven inflation on top of slowing economic output, you don't get growth. You get stagflation. Here's the brutal paradox. Trump promised cheaper energy, cheaper goods, a booming economy, and some of those promises are being tested right now in real time, with gold, silver, and oil as the scoreboard. Speaking of which, let's talk about that scoreboard. Let's start with gold, because gold is the asset that is basically screaming at the top of its lungs right now. As of today, March 5th, 2026, gold spot price is trading at approximately $5,171.50 per ounce, up about 0.68% just today, up over 4% this month alone. And over the past year, gold has surged an almost unbelievable 77.7%. Let me put that in perspective. A year ago, gold was around $2,900 an ounce. Today, it's over $5,100. If you had put $10,000 into gold 12 months ago, you'd be sitting on roughly $17,700 right now. Now, gold's absolute peak this cycle hit $5,608 per ounce, an all-time record. Earlier this week, gold touched $5,400 again as geopolitical tensions flared up. And just in January of this year, January 28th to be exact, Reuters reported that gold scaled a new all-time high of $5,181.84 as investors flooded into safe haven assets. So why is gold on fire? Let me give you the 5 reasons that every serious analyst is pointing to right now. Reason number 1, the US-Iran conflict. This is the most explosive development happening in global markets right now. US and Israeli forces have been conducting strikes against targets in Iran. Iran has retaliated with missile attacks on neighboring states, including key energy facilities. This conflict is now in its 6th day with no sign of resolution. When wars break out in the Middle East, especially involving Iran, money flows into gold. It always has. It's doing it right now. Reason number 2, central bank buying. The world's central banks, China, India, Russia, Turkey, have been buying gold at a historic pace. The US holds 8,133 tons of gold reserves. China just announced another increase to 2,306 tons. This isn't retail investors. This is sovereign wealth buying gold as a strategic hedge against the US dollar. That tells you something. Reason number 3, weakening dollar pressure. Trump's tariffs are creating paradoxical dollar volatility. Sometimes investors run to the dollar as a safe haven. Other times, the uncertainty of tariff wars and geopolitical chaos actually weakens dollar confidence. When the dollar weakens, gold goes up. It's that simple. Reason number 4, Federal Reserve uncertainty. Markets are watching the Fed like a hawk. Interest rates are currently sitting at 3.75%. With stagflation risk rising, the Fed is in an impossible position. Raise rates to fight inflation or cut rates to stimulate growth. Right now, traders expect the first rate cut won't come until September at the earliest. That uncertainty is gold's best friend. Reason number 5, thin market liquidity and outsized swings. CME Group recently reported a single-day metals trading record of over 3.3 million contracts on January 26th, shattering the previous record. The market is moving fast, and the moves are big. What's the outlook? Deutsche Bank and Societe Generale have both issued forecasts calling for gold to hit its $6,000 per ounce by year-end 2026. Even if we pull back from here, the structural bull case for gold has never been stronger. As Bank of America's commodities strategist Michael Widmer put it, rallies normally end because the drivers that took people into the gold market originally dissipate, and that's just not the case right now. Okay, now this is where things get really interesting and really complicated, because silver in 2026 is the most debated commodity on the planet right now. Here's your March 5th update. Silver is trading at approximately $84.59 per ounce oil today, up about 1.32% on the day. Over the past month, it's up 8.5%, and over the past year, over equal 159% gains. Silver has tripled. But here's the crazy part. Silver already traded as high as 121.78 per ounce. Earlier in 2026, according to MarketWatch futures data, it hit a record high of 117.69 on January 27th, per Reuters. Investopedia reported it hit $93 per ounce in mid-January alone. Silver went from being a sleepy precious metal to one of the most volatile, most debated, most traded commodities on Earth in less than 18 months. So what's driving it? 2 words: industrial and safe haven. Silver is unique because it's not just a precious metal, it's an industrial metal, and in 2026, it's at the center of 4 of the most powerful forces in the global economy. Force number 1, solar panels. The world is building solar power at record speed, and every single solar panel needs silver. New TOPCon solar technology actually requires more silver per panel than older designs. The Silver Institute projects the market will remain in a structural deficit for the 6th consecutive year in 2026. Demand is outpacing supply by a lot. Force number 2, AI and data centers. Artificial intelligence requires massive amounts of computing infrastructure. That infrastructure requires silver. AI chips, cooling systems, circuit boards, all silver dependent. The AI boom is not slowing down. Force number 3, EV batteries. Electric vehicles use silver in battery contacts and charging systems. With EV production ramping globally, this demand stream is structural and growing. Force number 4, safe haven demand. Just like gold, silver is a safe haven asset. And with stagflation fears, Middle East conflict, and dollar uncertainty, investors are piling in. Now, here's where the debate gets heated, because not everyone agrees on where silver goes from here. Bank of America has a long-term price target of $309 per ounce for silver. $309. That would represent a roughly 265% gain from today's price. Citibank recently upgraded its short-term silver price forecast to $150 per ounce, up from their prior target of $100. They're saying we could see $150 sooner than most people think. Investopedia's Vonda Research called this a structural accumulation that has now surpassed the heights of the 2021 silver squeeze. This isn't just a meme stock spike. But, and this is important, JP Morgan has flagged the risk of a sharp pullback. Their analysts have warned that silver's volatility cuts both ways. A pullback toward the $50 range is not off the table if global economic conditions deteriorate sharply. The Silver Institute confirmed just last month that global silver investment is expected to remain strong throughout 2026, even as the market faces a sixth consecutive annual deficit. Bottom line on silver, it is the most volatile, most exciting, most debated trade in global markets right now. If you're watching silver, buckle up, because the ride is far from over. Now let's talk about oil, because here's where the story takes a twist. While gold and silver are reaching record highs on fear and uncertainty, oil is telling a completely different story. As of today, March 5th, 2026, WTI crude oil is trading around $75.38 per barrel. Up slightly on the day, actually, about 0.96%, thanks to Iran war fears briefly spiking energy prices. But the broader trend for oil is bearish. Just look at where oil was earlier this year. Fred data from the St. Louis Federal Reserve shows WTI hit a low of just $65.10 per barrel on February 26th. That's multi-year lows. And December 2026 futures, they're pricing in around $66 a barrel towards us by year-end. That's not optimism. That's a market betting oil keeps sliding. So why is oil falling while gold and silver soar? Three massive forces are at work here. Force number one, OPEC Plus is flooding the market. Just days ago, on Sunday, March 1st, OPEC Plus shocked markets by agreeing to raise combined crude output by 206,000 barrels per day starting in April. That is a massive supply increase at exactly the wrong time. Saudi Arabia, Russia, Iraq, UAE, Kuwait, Kazakhstan, they all agreed to pump more. Reuters confirmed the news, and the oil market's reaction was swift and sharp. Why would OPEC do this? A few reasons. Saudi Arabia wants to discipline rogue members, Iraq and Kazakhstan, who have been overproducing beyond their quotas. And yes, Trump has been publicly pressuring OPEC to pump more to lower gasoline prices for American consumers. OPEC officials denied Trump had influence, but the timing is interesting. Force number two, Trump tariffs crushing global demand. Here's the brutal irony. The same tariffs that are supposed to make America stronger are crushing global oil demand. Tariffs slow trade. Slower trade means less manufacturing. Less manufacturing means fewer factories running, fewer ships shipping, fewer planes flying, all of which burns less oil. Goldman Sachs slashed its oil forecasts specifically because of this. S&P Global projected tariff wars could cut oil demand growth by 500,000 barrels per day in a worst-case scenario. Force number three, U.S. producers getting squeezed. This one's close to home. The Dallas Federal Reserve survey found that, on average, U.S. oil producers cannot profitably drill new wells at current prices. Major producer Diamondback Energy told investors that U.S. onshore oil production has likely peaked and will begin declining. NPR reported this bluntly. The combination of tariffs and OPEC Plus production hikes has brought prices low enough to hamper U.S. production. That directly contradicts Trump's drill baby drill promise. But here's the wrinkle today, the U.S.-Iran conflict. Iran is a major oil producer, and its Strait of Hormuz corridor handles roughly 20% of global oil trade. If this conflict escalates, if shipping lanes get disrupted, oil could spike dramatically and quickly. That's the wild card keeping prices from collapsing further right now. IEA's February 2026 report projected global oil supply rising by 2.4 million barrels per day this year. That's a lot of supply. Unless a major disruption hits, the bearish case for oil is hard to argue with. So let's bring this home, because all of these numbers mean something real for regular Americans, not just hedge fund managers in Manhattan. Here's how stagflation hits your wallet directly. Your grocery bill is up, your rent is up, your credit card interest rate is still near historic highs. The things you buy are more expensive, largely because tariffs raise the cost of imported goods. That's inflation. That's the first half of stagflation. But here's the second punch. Growth is slowing, which means wages aren't keeping up, which means job security is shakier, which means the good times that were supposed to follow the pandemic never quite arrived for tens of millions of Americans. Lower oil prices are giving you a break at the gas pump. That's real. Gasoline prices have actually gone down this spring, which is unusual because they typically rise this time of year. And lower oil means cheaper shipping, which eventually lowers prices of some goods. But economists at Pantheon Macroeconomics estimate that the benefit from lower oil prices is being almost entirely canceled out by the economic hit to oil-producing communities across Texas, North Dakota, and Oklahoma, who are seeing layoffs and spending cuts. It's a squeeze from both sides. That's stagflation, and it's back. All right, let me give you the clean, crisp March 5th, 2026 price summary. Your scoreboard for today. Gold. $5,171.50 per ounce, up 0.68% today, up 4.08% this month, up a staggering 77.69% over the past year. All-time record high, $5,608. Deutsche Bank and Societe Generale targeting $6,000 by year-end. Silver, $84.59 per ounce, up 1.32% today, up 8.5% this month, up 159.4% over the past year. Record high this cycle, $121.78 per ounce. Bank of America long-term target, $309. Citi's near-term target, $150. JP Morgan risk scenario, pullback to $50. Oil, WTI crude, $75.38 per barrel, up slightly today due to Iran conflict fears. Broader trend, bearish. Multi-week low hit $65.10 on February 26th. OPEC Plus adding 206,000 barrels per day in April. December 2026 futures, $66 per barrel. Some analysts warn of a potential $50 floor scenario if oversupply continues. One asset going up on fear, and industrial demand, and one asset going down despite one of the most dramatic geopolitical crises in years. That disconnect, gold and silver soaring while oil struggles, tells you everything about who's winning and losing in the 2026 economy. So let's answer the questions I know you're thinking right now. Should I buy gold? Look, I am not a financial advisor, and this is not advice. What I can tell you is that every central bank on earth is buying it. Every major bank has raised its price forecast. Every time geopolitical or economic uncertainty spikes, gold goes up. The fundamentals driving gold are not going away, but at $5,100 an ounce, you need to think carefully about entry points, position sizing, and your own risk tolerance. Talk to a licensed advisor. Is silver too volatile to touch? Silver's 159% gain over the past year is breathtaking, but so is its volatility. It went from $117 to $82 in a matter of weeks. The bull case, AI demand, solar panels, supply deficits, safe haven demand, is real. The bear case, JP Morgan's warning of a potential $50 pullback, is also real. If you believe in the industrial demand story and you have a long time horizon, silver makes a structural case. If you're looking for a quick trade, understand the risk. Will gasoline prices keep falling? Possibly. Lower oil prices mean lower pump prices, but the Iran conflict is a wild card. If oil shipping lanes get disrupted in the Strait of Hormuz, prices could spike overnight. The direction of oil is being pulled by three forces simultaneously: OPEC pumping more, tariffs killing demand, and geopolitical risk keeping a floor. Watch the headlines. Is stagflation going to cause a recession? RBC says it's stagflation light, not a full-blown recession. Goldman Sachs projects global growth of 2.8% in 2026. Apollo Global's Torsten Sluck puts recession odds at about 10% for 2026. It's not a foregone conclusion, but the warning signs are real, and the next 6 months are critical. This is where we are on March 5, 2026. Gold at $5,171, silver at $84.59, oil at $75.38, a Middle East war in its sixth day. OPEC flooding the market with supply, tariffs pushing inflation up while growth slows down, economists from RBC to Goldman Sachs sounding the alarm on stagflation. This is not a normal market. These are not normal times. The question is, are you watching or are you prepared? If this video gave you value, please hit that like button right now. It helps more Americans find this information. Subscribe if you want real-time updates on gold, silver, oil, and the U.S. economy. I cover it all every single week. Drop a comment below. Tell me, are you buying gold or silver right now? Or are you waiting for a pullback? I read every single comment, and share this with someone who needs to hear this. Your family, your coworkers, anyone asking, why are prices so high? This video answers that. I'll see you in the next one. Stay sharp, stay informed, and as always, take care of your money because nobody else will. Closing disclaimer. Disclaimer. This video is for informational and educational purposes only. All commodity prices mentioned reflect data available as of March 5, 2026 and are subject to change. This content does not constitute financial, investment, tax, or legal advice. The presenter is not a licensed financial advisor. Investing in commodities involves significant risk, including the potential loss of principal. Always consult a qualified financial professional before making investment decisions. Past performance is not indicative of future results. Trading Economics, Reuters, WSJ, CNBC, Bloomberg, RBC Economics, Goldman Sachs, Silver Institute, and Fred St. Louis Federal Reserve data, cited for informational purposes only.